If you're looking into a DSCR loan, there's 5 surprises that you want to avoid, and this will save you time, money, and energy. Higher than expected insurance. Because this is an investment property, lenders are going to require rent loss coverage equal to 6 months of the qualifying rent liability coverage, equal to $100,000. Also, you might be buying a property in a different state that you're unfamiliar with or a different area. So be careful to be able to just do your ratio or what you think insurance might cost based on what you know. Make sure you actually get quotes from areas, especially in states like Florida where there's hurricanes and wind, or California where there's fires. And then some areas there might be flood zones that require additional flood insurance, which can make the property go from cash flowing to being a negative cash flow property. So get a local quote from an insurance person if your numbers are tight. I would suggest doing that either way, because in certain states it can be several $100s in premium every single month. Higher property taxes than people expect because they're, again, purchasing a property somewhere else. Some states without income taxes typically have higher property taxes, or some areas not only have a county property tax, but they also have a city or municipal tax. Many states, you might go onto the county records and search the old tax certificate, or go to Zillow and it tells you what the property taxes are. But property taxes actually reassess when the title transfers. So you don't want to go off the current tax bill, because if the person's lived in that home for many years and you're in the state of like California and San Diego, let's say, it's 1.25% of whatever the purchase price is. Okay, so 1.25% of whatever the purchase price is divided by 12 months is going to be the new property tax for the annual taxes. So you want to do your research. You do want to go to the tax collector, look up what the bill is, then Google what the normal transfer policies are. Make sure that there's no other taxes in the area. You might work with a local title person or real estate agent to be able to help you out with that, or reach out to me and I'll do what I can to be able to make sure that we're getting the correct taxes up front so you don't run into any surprises down the road. 3 is lower than expected rental income. So appraisers are going to use comparable rental properties to calculate what they believe market rents will be. So make sure when you're evaluating rents that you're not going to go off of one property that you know about, or what somebody's willing to pay you for rent, or what a real estate agent tells you, unless they actually provide you with the comps. What you need to do is you need to find 3 to 5 comparable rentals with the average rental lease over period of time within the past 6 months or so. Okay, obviously if there's not 5 there, we want at least 3, and if there's not 3, you might need to go further than 6 months. But ideally, a comparable property would be within a half mile of the subject property, the closer the better, within 150 square feet of the subject property, as well as close to the same number of bedrooms, bathrooms, and then you need to look at pictures online. Is that one remodeled and yours isn't? Or is yours remodeled and that one isn't? Okay, all those things are going to come into play. What I would do is there's, obviously rent estimates online on realtor.com, Zillow, and those places. Or you can also send me a property and I can do my own comps for you. And you should be working with a realtor that's willing to do this as well. Between all of that, you should get a great idea of what this property should rent for. That way we can calculate based off that. If the property still ratios out and you like the numbers, then we can go ahead and pay for the appraisal. The last thing that we want to do though is pay for appraisals, have them go out, only to find out that the property isn't going to ratio. And number 4 is prepayment penalties. DSCR loans typically have a prepayment penalty. Some lenders do have no prepayment penalty options, or options up to 5 years. And this is going to come into play if you refinance, sell the property, pay it off, or even pay down the loan amount to a certain balance with some DSCR lenders. So you want to make sure that you're asking them the terms of any prepayment penalties. The most common prepayment structure for DSCR loans is known as a step down. Typically, a 5-year would be a 5-4-3-2-1, meaning if you pay it off the first year, you're going to pay a 5% prepayment penalty on the remaining mortgage balance. On the second year, you're going to pay a 4%, third year, 3%. If it's a 3-year prepayment penalty, it's going to be 3-2-1. So first year is 3%, second year is 2%. Now, if it's a fixed fee percentage, and it's a 3-year prepayment penalty, it's going to be a 555, indicating that the 5% penalty will be for the entire first 3 years, but it'll only be on the remaining loan balance. Now, some lenders do have options for no prepayment, but generally opting for the higher or longer prepayment penalty can lead to a lower interest rate from the lender. So you just have to weigh the pros and cons potentially of taking on a prepayment penalty. If you're in a high rate market and you feel like you can refinance in the next 18 to 24 months, then I wouldn't do a prepayment penalty over 2 years. And number 5, lastly, higher than expected closing costs and reserves that are needed. Okay, some states have higher fees like transfer taxes that can be expensive. So Florida has a current transfer tax that is 70 cents per $100 that is purchased. So for a house worth $392,306, which is the median home price in Florida, the transfer tax that would be due would be $2,746. That's just the transfer tax. It doesn't account for actual property taxes that might be due as well. Also, you might not remember this because maybe you purchased your home a long time ago, but homeowners insurance, the annual premium is actually paid up front all 12 months. And then most lenders are going to require 3 to 6 months reserves of the housing payment of the property that you're purchasing or refinancing. So that means principal, interest, property taxes, insurance, and any association dues. Now, that's not something that you're bringing to the table. They just want to see it in a bank account. So checking, savings, and then if it's in a retirement account of some sort, you do want to ask the lender if they cut a percentage of it off of what it's valued as. So some lenders will say, yes, we allow retirement accounts as reserves, but only 50%. So if you have 20,000 in a retirement account and they cut it by 50%, well, then you have 10,000 in reserves according to the lender. So you just want to make sure that you have enough available. If you want to make sure that you avoid these surprises and anything else that might occur, feel free to scan my QR code here. You can schedule a time to talk to me. We can run through any scenarios. I can go through all of your options, answer all of your questions. We can go through and look at any past properties that you've looked at to see if they would have potentially worked, if you have any new properties, or if you own any that you're thinking about maybe doing a cash out option on. We can run through it all, give you different options. That way you can see, here's what a 3-year prepay looks like versus a 5-year. That way you can choose what's best for you and your individual situation. You can also email me any scenarios at trevor@harborfunding.group or give me a call or text at 619-404-6637. I love working with investors. Even if you're a first-time investor, don't be afraid to ask your question. We were all there once, so feel free to reach out to me. I'd love to work with you as well.